Good afternoon, everybody. It's Scott Gillum back with a ShadowTrader SquawkBox short video for the 2nd of May. With the way the market has gone on a rollover in March, and now the FOMC rate decision and discussion has passed us by, it appears that this market, especially the NASDAQ, the QQQs are what I'm looking at, may be in a what is deemed a consolidation stage, to where they're still looking for more information to make a move, whether it be up above this trend line or down below some very significant Fibonacci levels and the low that we saw back in the middle part of April. So how can we play this? Well, we can sell credit above on any sort of break to the upside, and we can sell credit to the downside as long as this market doesn't take a big nosedive. Now, the way that I've got this set up for you folks needs to have one criteria. We need to wait for the non-farm payroll report tomorrow at 8:30. That could make this trade, this chart, these NASDAQ stocks absolutely invalidate any sort of stabilization, consolidation, whatever you want to call it. So remember, wait for non-farm payrolls to come. Take a look at the setup that I'm going to give you around the 10 o'clock Eastern time to 10:30 to see if it still makes sense, and I'll give you those targets that I'm looking for. So let's go to what the trade looks like. Any breakout has to reach around this 440, 445, 450 level, and a breakdown below the 38.2 retracement from the top would need to be around this 410 to 400 level. So let's take a look at the trade itself. I want to look at the May 17 expiration. That's the OPEX for the month of May. If I take a look at where we're trading right now, we're trading at 426. That's an at the money situation. By scrolling, I can see where one standard deviation sits on my strikes. That's around 409, 410, thereabouts. And on the other side, we've got 440. So here's the way the trade sets up. I want to sell both the call side and the put side. If I sell a 405, one standard deviation outside of its expected move between now and May 15 or May 17, I can do that for 92 cents, capping off the risk to a maximum of $500. I have to pay 58 cents. So I've got about a 40-cent credit on the put side. On the call side, selling the same type of situation, 445 outside of a one standard deviation move. I'm giving a little bit more wiggle room to a bullish bias here. So sell the 145, buy the 450. So I've got a 400 sale, pardon me, a 405 put sale, a 400 buy. I've got a 445 sell and a 450 buy on the call side. Right now I could put that on for 81 cents. $5 wide, 81 cent of credit on this trade. That's approximately a 9% return on your risk. Now let's take a look at the curve itself. There's your outside numbers. The 405 put on the short, 445 call on the short side. Here's where your profit line is. Note the 77% probability. That means that there's a 77% probability that I will make any profit any profit at all, whether it be a penny or not. But I will stay outside by 77% from a 405 level all the way up to 445. Back to the chart. 445, that's up to the trend line. A break of that would invalidate the bear call side. On the 405, a break of the 38.2 would invalidate the bull put side. But the way it sets up, stagnant trend for the next couple of weeks seems more likely than not. So there you go. Hi there, I'm Scott Gillen from the ShadowTrader SquawkBox, and I want to thank you for watching this video. If you like this content, make sure you hit the like and subscribe buttons, and if you'd like to trade with me live every day in real time, check out ShadowTrader SquawkBox at shadowtrader.net/squawk or at the link in the description below. Good trading to you all, and I'll see you in the room.